Buddy and Carlo, who both sent me emails, they send their regards, but because of family emergencies and other reasons, they can't make it tonight. In any event, Young Hong says, can we just take a quick look again at problem 3-31, right? 3-31 is just trying to illustrate the Keenan case. And then there's a specific request of a specific dollar amount being satisfied with appreciated property. That's going to give rise to gain. The gain is capital gain. And because capital gain is not considered part of D&I, right? The D&I will say $20,000. Okay? So the answer will not change, but the trust or estate will have an extra $1,000 worth of capital gain. All right? So what I'd like to do, move on to chapter 4. And by the way, if you wouldn't mind, I just will call this to your attention. If you have a moment, I took a look, and maybe you guys can help me. If you have the problems, we're going to have the problems. If you didn't bring it tonight, maybe Barry, you didn't bring it? Maybe Javier has
I
it.
couldn't find it for like 2 weeks. I'm like, oh, here they are.
Javier, did you bring it? No, no?
Oh, no, actually, I did find him finally. I think I was cleaning up some other crap on my desk.
Dustin, you bring yours? Is it yes or no?
Yeah.
You got it, okay. Well, if you can just look. Let me just talk for 2 minutes. I don't want to spend a lot of time on this. Come on, did you bring it? Okay, good. Look at problem 6 for a second. And then we're going to move on to grantor trust. But I meant to bring this up earlier, but that's okay. If you look at chapter 6, it talks about interest being earned, dividends, long-term capital gains, and let me just make sure I get the right one here. I apologize. Let's instead, I apologize. Let's look at example 7. Example 7. Estate final year. And I think I can figure out most of this myself, but I want to hear your opinion, guys, if I'm missing something. So, the estate's final year, it has interest and dividends of $4,000 and $3,000. It has a long-term capital loss, long-term loss carry forward, and long-term capital loss carry forward. Okay? So, it's got lots of losses, 48,000 of long-term losses, and it's got short-term losses of 15, right? If you look at the total, there's a carryover of the long-term, and this year itself had 23,000. And normally in a estate, during its final year, that's when the accountant and attorney charges their money. So they're going to charge, say, professional fees of 25,000. And the fiduciary fees of 20,000. So lots of fees being charged, right? Everyone agree? And not much income being earned, but that's not unexpected, right? Everyone agree? This is realistic. So let's just look at the 1041 for a second. It's checked off that it's the decedent's estate at the very top. It's checked off that it's the final return. It shows the income of $4,000 and the interest income of $3,000. But remember, under Code Section 1211, that you can use up to $3,000 of the capital losses here, right? To reduce the taxable income to $4,000. Everyone agree? Okay. We're all on the same page. And we have the fiduciary fees of $45,000 together, right? That's the 20 plus 25. And the taxable income, you know, is gonna be 41,000. Now, and there's considered, the way they did this, which we can ignore for a moment, is that they consider it as if there were a $10,000 distribution deduction, because the estate made estimated payments that they're gonna deem to be paid out by the beneficiaries. That's not what interests me here. What I find interesting is that, and we know it's an estate, so it gets a $600 exemption. All that makes sense. But look at the K1 for a second. Because in the final year, these deductions get passed through to the beneficiaries. Everyone agree? And I get the fact that if you look at the K1s, I get that you see where it says qualified dividend A, B, and C, item 11? And I see where it has long-term capital loss of 23 plus 25 is 48.
Where are we at again?
I'm at the K1. Let's, everyone see this?
I see a line 11.
It's item 11.
Oh. Okay, yeah,
Okay, and you see right here? So each of the beneficiaries can get 24,000 of the capital losses. Right? There's one beneficiary and there's two beneficiaries, each 50-50. Okay? And short-term loss, there's 15, so they could each get 7,500. I'm not entirely sure where the 19 comes from. Now, I can back into it. If you look at the second to last page, it takes the $41,000 of losses, and they add the $3,000, the $41,000 of losses, right? And they add back $3,000, right? Because I guess what they're doing is that capital loss can't be used twice, and you're already using it once in the amount being pushed out. Like the capital loss here really shouldn't be a total of 48,000 because they're using 3,000. So what they're doing is they're giving the capital loss, but they're saying the loss is not really 41,000. That the loss is only 38,000 because the $3,000 of capital loss can't be used twice. I guess that's what they're saying. So that's where that $19,000 comes from. Why am I showing you this? Because again, these numbers get distributed, right, to the beneficiary, and the beneficiary can use the capital losses, right? Can use the capital losses. They get pushed through under what authority? Code section 642H, right? They get the capital losses. But the excess deductions here, the 19,000, those constitute miscellaneous itemized deductions, and that 19,000, at least for now, under code section 67G, cannot be used. So I just want to give you an idea in a final year what the estate tax return might look like. All right, I don't want to overdo a thing, but I just want to give you a glimpse. We had spoken about it last class, give you an idea. So far, chapter 3 gives you a good idea of how to compute D&I, what's a simple trust, what's complex trust, how to differentiate it from Code Section 663, excess deduction 642H, and at the very end, the application of Code Section 643, E1, E2, and E3. That's what we just looked at. Which otherwise, you guys might be befuddled because, if you don't mind me saying, you, like most people, until you knew how Code Section 643, E1, 2, and 3 operated, you might have made certain assumptions that, if you don't mind me saying, probably weren't true. But now you have a much better handle on it. At least I hope you do. We're about to enter a new world. The world of grantor trust. Like I said, NYU offers, for those who stepped in a little bit late today, NYU offers a course on grantor trust alone. So just keep that in mind. We spent a portion of last class discussing grantor trust, and we said the number one grantor trust in existence is what? What kind of trust? Don't disappoint me, guys. The number one trust. Revocable, right? The number one trust that is treated as a grantor trust, a trust which is ignored for tax purposes, right? And we equated grantor trust to what kind of entity? A single member LLC, right? Single member LLC. And why do the authors begin this chapter with a discussion of the assignment of income doctrine? What is the psychology of Mark Asher and Rob Danforth for having a lengthy discussion about the assignment of income? The question, remember, when I talked about, for those who've had me for income tax, when I talk about the assignment of income, it's never a question of how much, what's the character, it's a question of who gets taxed, right? And that theme becomes even, it really resonates in this context. And how do you tell who gets taxed in the context of the assignment of income doctrine? It's a matter, in large part, of do you control, directly or indirectly, the money? Do you control the money? And depending on how much control you have, will dictate whether or not you should be subject to tax. So, for many of you, the first few cases here really constitute a review of material you've seen before. And I've said, for those who've had me before, that there's about 10 cases that, as a tax professional, you should know. And one of them happens to be Lucas Bureau. Because essentially it stands for a simple proposition that the person who earns, whose sweat and toil earns income, should bear the tax onus associated with such income. The person who earns such income should bear the tax onus associated with such income. And this case gave rise to the genesis of the so-called fruit and the tree metaphor, right? That you guys will never forget. And we talked about ripe apples, and if it's your tree and the apples grew as a result of your efforts, you should be taxed on the ripe apples. Everyone agree? All right. So just to remind people, the last line of the case, or Justice Holmes talked about the fruit and the tree metaphor And what we see here are a series of cases. I really don't plan on your final exam to be testing you on the assignment of income doctrine. But in the Player decision, if you recall, the taxpayer here gave away the entire interest they had in a trust. And as a result, when they gave away the entire interest, they gave away the tree. And if you give away the tree, the recipient will be taxed on the income going forward, right? Give away the tree, the recipient will be taxed on the income. Elbring v. Horst. Famous case as well. See, the first case, Lucas v. Earl dealt with service income. Elbring v. Horst deals with property. And in this case, the taxpayer had a bond with interest on it. The bonds generated interest income. And the taxpayer sought to distribute the interest coupons to his children. And we have to presume here, given the year involved, there was no such thing as the so-called kiddie tax. So his children, he might have been taxed at a 77% tax rate. His children maybe were taxed at a 10% tax rate. So the taxpayer could save approximately 67 cents on each dollar, right? By having the interest income taxed to the children. And the court said, essentially by his giving the interest coupon to the children, he was deriving pleasure equivalent to as if he had spent it. So if he gives $100 interest coupon to his children, it's as if he got a $100 plasma TV. Like, there's equivalent, to use the utilitarian phrase, of utils, right, associated with the gift giving. And the court points this out on page 251, the second full paragraph in the middle. It says, even though he never receives the money, he derives money worth from the disposition of the coupons, which he has held, or he has used his money or money's worth in procuring of a satisfaction, which is procurable only by the expenditure of money or money's worth. It goes on 2 more paragraphs below. The power to dispose of income is the equivalent of ownership over it. And towards the very end of the bottom of page 252, top of page 253, but let's start with the bottom of it. When a gift of the coupons, he has separated his right to interest payments from his investment and procured the payment of the interest to his donee. He has enjoyed the economic benefits of the income in the same manner and to the same extent as though the transfer were of earnings. And in both cases, the import of the statute is that the fruit is not to be attributed to a different tree from that on which it grew. So again, there's an emphasis here that even if you don't continue to own the property, your indirect control of the property makes you taxable. And we'll see when it comes to grantor trust, this is all leading somewhere. This is not arbitrary. That if you control a trust, that even though you don't directly own the assets, but you control them, emphasis on the control and dominion, that control and dominion will be sufficient to make you taxable on the income, okay? So isn't that true of these assignment of income cases, that if you have sufficient control, that's going to warrant that you are taxable on the income? And that was true in Elbring v. Horst. The taxpayer lost in that case because the temporary, just giving, if you retain the tree and just give away the fruit, you're going to remain taxable on the fruit. And the same held true in Harrison v. Schaffner. Again, we have very, very similar verbiage of the taxpayer retaining, retaining indicia of control. So on page 256, the last paragraph, right in the middle towards the right, it says, "It is enough that we find the present case, the taxpayer in point of substance has party with no substantial interest in property other than the specified payments of income, which, like other gifts of income, are taxable to the donor." So again, it just goes through all these cases in which taxpayer retained control. If you retain enough control, there's a case, I don't recall the name, where a judge once said that if you have enough strings attached to property, you will get the equivalent of broker, right? And in that case, it dealt with estate tax issues. And with respect to grantor trust, did people want or not want grantor trust status prior to 1986? Did they want or not want?
They don't.
Is that they want or not want? Was grantor status good or bad?
Good.
It was bad.
It was good.
It was bad. Not
not
Michael
my
Jackson bad.
It's
Okay?
not my
It was
business.
bad.
Okay.
Right? Because people wanted trusts to avail themselves of the lower trust rates prior to 1986. And if the IRS could come back and use it as a sword and say you have a grantor trust, that meant you were going to be taxed at the higher rates of individuals, right? Everyone agree? Karen, what's the problem?
Oh, no, I'm just saying, it's like, again, this whole chapter's on a disregarded entity, that seemed like a lot, but, okay, so you're
I
saying.
tell you, there's a
before-
whole course on it.
Okay, yeah, definitely not. Okay, now, all right, but now you're saying, okay, you could get lower rates, right, if you were in a lower income bracket as an individual, or they'll probably not if you have an.
Well, now in 1986, you probably do, and people do seek grantor trust status, and if you Google intentionally defective grantor trust, people, Alicia's shaking her head yes, that people specifically seek to set up intentionally defective grantor trust. People seek now to establish grantor trust status. If I were king for the day, if you get bored, if you actually look in the supplement, Mark Asher and Rob Danforth, if you look at their update, an article I wrote in the Notre Dame Law Review, I make an argument that grantor trust status should be abolished, essentially. Okay? Going forward, there's no need to have this complexity. If Congress thought about it for a moment, just do away with grantor trust status. So I share your view. Like in this day and age, with the this used to be this whole regime that we're going to look at, used by the IRS to defeat taxpayers' ploys at setting up trust to avail themselves. There's no longer a reason to have this whole regime, but we have it. And last I checked, Congress has made no overtures to get rid of it.
This is, like you said, the revocable trust, right?
Revocable trust, but it could be irrevocable. You can have grantor trust status, which we're going to see in a few minutes, with irrevocable trust.
See, now, a revocable trust, I'd be nervous to make, because then you said it becomes irrevocable when you die, so somebody might try to kill you just to make it irrevocable.
Well, first of all, they have to be a named beneficiary.
Oh,
And they probably, if you have a good sensibility about people, if you think they may kill you, you may not want to name them. So, one of those things. Presumably, you think they're good people, and that's why you're naming them.
If they kill you, you'll be a prime suspect, or if you kill them,
You
you'll be
could.
a prime suspect.
By the way, there are statutes in New Jersey that if you do kill someone and they leave something in your will to them, you're considered to have predeceased them. So if your spouse wants to do you in because your spouse thinks, gee, you're going to leave them a lot of money, if they do kill you, sorry to them, they don't get anything. There's a shocker. I know this sounds, I mean, I've had one definite, one maybe, but one definite, where one of my clients, how do I say this, her husband, a podiatrist, hired a hit person to knock her off because of insurance proceeds, and he had a girlfriend. And, I mean, you can't make this stuff up. I mean, it exists.
Was that,
People-
that was in the newspaper, wasn't it?
It was in the news.
Yeah,
But there's a lot of them, so I don't feel like I'm
I
giving away my
remember that.
client's confidences, because she's not alone, but there's a lot of people.
What if they give you rights to, like when they're incapacitated in the hospital and they tell you you're the one who's gonna pull the plug? Does the law applies? 'Cause I have
No,
older
no.
boys,
No,
so
that-
really
No, it
trust
doesn't.
is different.
That's different, that's a healthcare
Yeah.
power appointment. But you gotta choose the right people. You don't want the person who accidentally kicks the plug and says, whoops! All right, so, anyway, let's talk about, let's make sure that we progress here, because that's a lot of background to the main course here, okay? And let me just talk about grantor trust in general, and so grantor trust refers to a trust over which a person has retained sufficient interest or power for tax purposes. He's treated as the owner of such property. As owner, he must report the income earned by the property directly on his tax return. And depending on its nature, he doesn't have to file 1041. Now we're going to go through this, and depending on where we end tonight, keep in mind, our objective is twofold. Objective one, can you identify if it's a grantor trust? Right? That's key. Identification. And I've said, as you guys know, a lot of tax issues just involves proper identification. Can you identify, is it a simple trust, is it a complex trust? And once you make the identification, things begin to fall into place. Agreed? So you guys, with me, together as a team, we have to decide if something warrants grantor trust status. The second leg of our journey through chapter 4 is once we make this identification, what are the tax consequences? So first is, let's identify, if it's not a grantor trust, what world are we in? We're in the world of chapter 2 and 3 of our textbook. Everyone agree? Been there, done that. If we're in the world of grantor trust, then we have this new regime. And one of the most famous cases, well-known cases, a case which has now been overruled, but it still makes sense to know about it because it's sort of the ship that launched. What is the ship? Help me out. I should know this. What is the ship that they say launched the Trojan War? Right? Help me with that. What's the name of the guy who chased his girlfriend? And it's this. What is it that the ship that launched it? No one's gonna help me on your Greek history. All right, I'll see if I can find it, or if B finds it quickly.
My laptop is dead.
All right,
Sorry.
your laptop. All right, we'll see. If someone thinks about it, circulate it. I'll send an email around.
I thought it was the horse.
Javier, you don't
Yeah,
know
I was
it?
gonna say the horse too. I was like,
It's not
it
the
was-
Trojan horse, guys. I'm talking about someone. This guy chased this woman.
Paris.
Like, Paris.
Oh.
Yeah, Justin, and he chased. What was her name?
Ace went after the Queen of Sparta, who came back home with Paris back to Troy.
Right.
And the King of Sparta followed to Troy, and that's how the Trojan War began.
Exactly. But who was the king of Sparta who went to Troy? And she, what's her name? Because she's the one who, I think the cliche,
She is Helen.
Helen of Troy,
Uh,
launched 1,000. Isn't it the cliche launched
The King of
1,000?
Sparta was Menelaus.
Okay. I gotta get my players straight on this. The point is, my digression this case, Elbring v. Clifford, launched all these cases. I don't know, anyone read the Clifford case? Here, let me give you some of the salient facts now. Yeah, and you will hear periodically people reference so-called Clifford trusts, okay? You've heard people, I'm sure, reference so-called crummy trusts. Have you heard crummy trust references? C-R-U-M-M-E-Y. Crummy trusts are trusts that people set up that if suppose, Edward again, this time he's married to Alicia, he sets up a trust for Alicia's benefit, and I'm the trustee, and he gets $1 million insurance policy, so he better get a food taster, right? Just make sure when Alicia's feeding him that there's no poison going on there. And the insurance premiums are $10,000 per year. Everyone have the visual that Edward has an insurance policy on him for $1 million. I'm the trustee, I own that policy on Edward. And every year he's going to make a $10,000 contribution to the trust, okay? Now, when the estate and gift tax had some real teeth to it, and people were concerned, the exemption was at $600,000 for many, many years. It's now at $11,180,000. People like Edward were worried because whatever gifts they made during life, taxable gifts, reduced the amount they could get tax-free debt. But when you make a gift, only gifts of, and you're not going to be held responsible for this, but let me just tell you that when you give a gift of a present interest, what is the current exclusion? How much can you give gift tax free?
14,000.
15.
15.
Yeah.
It's 15. And the authority for that? It's Code Section 2503B. Okay? Code Section 2503B says you can give up to $15,000, but it must be a gift of a present interest, not a future interest. Right? Everyone agree? So if I give David $15,000, no gift tax return, Form 709 needs to be filed. But if I give David a gift of $100,000, the first 15 is tax-free. The other 85,000 absorbs 85,000 of my lifetime exemption. Everyone agree? And if I didn't have any lifetime exemption, I had given EK, I had already given her $12 million. So I used up my exemption, and now I gave David 100,000. The first 15 would be tax-free. The other 85, I would have to pay a 40% tax, right?
Oh, that's cumulative.
It's cumulative.
Oh,
Whatever I
I
give,
thought you could give each person.
oh, I could. I could give everyone in this room 15,000 and pay no
Oh,
tax.
no, that part, I'm saying the cumulative over your lifetime, yeah, if you did give this person 5 million, this person 5
No.
million. Okay,
It's
okay.
cumulative. But it's only, again, gifts of a present interest. When the Crummy case came out and said that when Edward set this up, if he contributed the premium amount of $10,000 and he gave the beneficiary a 30-day window period to withdraw the money, isn't the nature of a trust, when we put money into a trust, isn't it a future interest? Edward doesn't want that money to vest with Alicia until he dies, or even thereafter, right? It's setting up a trust, by its very nature, when you put money in a trust, you don't want the beneficiary to get his or her hands on it immediately. Agree? It's like the epitome of a future interest, right? And it looks like on its face, it should definitely use up part of your lifetime exemption. Everyone agree? But the creativity of the attorney or accountant in the Crummy case is they said, when Edward contributed $10,000 and Solon was the trustee, I gave Alicia 30 days when he made the contribution, she could withdraw it. And if she didn't withdraw it, the money would then vest with the trust, and I could use it to pay the insurance premium on Edward's life. So by having this window period of withdrawal, it's now known as a Crummy withdrawal window, named eponymously after that case. Okay, that's a good SAT word, eponymously. In other words, it's a word that takes on the name of the thing that started it. E-P-O-N-Y-O-U-S,
Like
I believe.
Googling?
Eponymously.
I mean, is Googling an example?
Yeah,
Okay.
Googling is an example of an eponymous name. And there's lots of those. Okay? Anyway, so crummy and Miranda rights, that's eponymously named after the Miranda decision, right? There's lots of cases and lots of things in life that you can now add that to your repertoire of new words. Okay? My point is, crummy trusts are very popular because you're able to transform this otherwise future right into a present interest by giving this window period of withdrawal, and court after court after court has sanctioned it and said, that's okay. So this is not untested. This has been tested time and time again. Okay, so I'm just sharing with you, and we're going to see this issue of crummy withdrawal powers come up later in the chapter. But it's a very common technique. I've set up a fair number of insurance trusts in my life, and every single one of them, without exception, has a crummy withdrawal power. And I'm not alone. Any trust I've ever seen funded with insurance always has that withdrawal power in it.
Is that the language that goes into the trust?
I'm sorry?
Is that the language that goes into the actual trust document?
It absolutely goes in the trust document. I give Alicia, and then if they had children, I would give their children the right to withdraw too. So that if the premiums on him were $50,000, not only could Alicia withdraw $15,000, and each of their children could withdraw each one $30,000, $15,000 apiece, because it's a split gift.
So when he dies and there's this 1 million insurance, it's not gonna be used against the lifetime.
Not at all.
No?
No.
Okay.
That's why people leverage this gift giving, because he dies, that $1 million goes into trust for your lifetime benefit. He's not used up any portion of his lifetime exemption.
That's for rich people.
That's where wealthy people do it all the time. I am sure, and I don't mean this pejoratively towards Donald Trump, I'm sure Fred Trump set up many of these trusts, and just to show it's not a Republican or Democrat thing, I am sure the Kennedys routinely set up these kind of trusts as well. So this cuts across party line, guys. All right, let's talk about Clifford, okay? And we have 1934, Clifford sets up a trust, declares himself trustee. The trust was irrevocable, so don't just think grantor trusts are only for revocable trusts. This was an irrevocable trust. Clifford paid some gift tax at the time. The laws were very different from what they were today. The trust was to last for 5 years, except that it would terminate on either his death or his wife's death, and Clifford would serve as trustee. So he's setting up the trust, and not only did he set it up as grantor, but he's going to serve as trustee. And as trustee, he has discretion to distribute to his wife. The income that he didn't distribute would go to his wife on termination. So there's only a question of when she would receive it. She would either receive it during the 5-year period the trust was in existence, or when the trust terminated, right? Everyone agree? And he held complete power when that income was going to be distributable. And the question is whether or not this should be treated as a grantor trust on the income that was earned. Now, we got to pause for a moment and look a little bit at the legislative history. And did Congress consider treating this kind of trust as a grantor trust? This is 1940 when this case is being decided. But was there something in the works where Congress had contemplated treating this kind of trust as a grantor trust? And the dissent in the Clifford case makes the point that Congress did consider and never acted, okay? So, just the laws at the time, a revocable trust was definitely a grantor trust, even back then. But this was an irrevocable trust. It was an irrevocable trust, and Congress had an opportunity to issue legislation, and it didn't. So just bear that in mind in this context. So the point I'm making and the dissent makes is that when our taxpayer, Mr. Clifford, sets up this trust in 1934, the attorney who set it up wasn't, how do I say, a cowboy. There's some attorneys and some accountants we know who are cowboys. Like, they take positions, you're like, really? This was not far-fetched, because this attorney or accountant, whoever helps establish it, could say to the taxpayer, look, Congress considered this issue, didn't proceed, you should be okay. Anyway, notwithstanding that Congress didn't act, the Internal Revenue Service decides to challenge this. And remember, the taxpayer likes this trust. Why does the taxpayer like this trust? Because the taxpayer can put money in, earn income, and the trust is going to be subject to low rates of tax. Everyone agree? It's the perfect tax shelter. Complements the laws back in the 1930s. Everyone agree? And has the taxpayer given up much by establishing this trust? Right? We have Edward and Alicia. We're keeping having you guys married. And since you're close, at least physical proximity, Edward, if you set up this trust for Alicia, do you think you gave up much by setting up this trust, assuming you have close kinship with Alicia? I mean, it's a short-term trust. Alicia and you, hopefully, fingers crossed, are on the same wavelength. I should mention, I saw in the New York Times book review, there's a new book that was just released that said, the title of the book is, If You're in My Office, It's Already Too Late. And it's written by a divorce attorney, okay? And he tries to give advice to people about their relationships. And what was the number one thing you can do to keep your relationship together?
Talk about money. Talk about money.
Talk about money?
Yeah.
Separate money?
Separate money?
Separate money.
Yeah.
This is interesting. He said, it's,
Well,
in his
infidelity is the
opinion,
number one reason for divorces. I know that.
is what? Money?
Money.
No, the number one is infidelity. The number two is money.
I'm not disagreeing. I don't
Kids,
know.
number one.
Kids.
What was that?
Parenting.
Children, number
Parenting.
one.
Yeah, parenting is a big one too.
Okay, but I will share that his reason of keeping it together, not splitting up, he said that you have to try to keep yourself interesting in a relationship. Like, you have to bring that to the table. Like, you have to make yourself an interesting person.
I think it should be forced. If it's not, there's no interest, you just get divorced, move forward, find somebody else.
But
I
then
don't
that's
know,
a
Alicia,
never-ending
it's not
cycle,
easy.
right?
Anyway, I had them married. I'm not trying to split them up. Edward, be interesting. Alicia, be interesting. So you guys stay together. Okay? Now, so the question is, when the IRS brings this case, should they or should they not win? And the court concludes, okay, examining this fact pattern, that Clifford should remain the owner. And why did they draw this conclusion? And they had three factors that led them to this conclusion. Factor one was the short duration, right? he wasn't giving it up for long, right? He set up this trust, and the trust was relatively short, which meant that he, if you set it up for one day, are you giving it up much? No. In this case, it was only 5 years. It's not a long period of time. And he was going to get the property back, the corpus back. So it's sort of like getting back to, in the Blair, Halbury v. Horst. If you give someone 1 year's worth of interest coupons, but you keep the underlying property, right? You remain taxable. But similarly, maybe if you give up 5 years worth, not giving up much if you retain the trade. So the duration was a problem. The fact his wife was the beneficiary was a problem. Why? Theoretically, that was his alter ego, right? So he's going from one pocket to the other pocket. Agreed? Agreed. And he was the trustee. And as trustee, he held control and the spigot whether or not the money got distributed or not. So he controlled Alicia's beneficial enjoyment. This way predated the Me Too movement, right? Alicia might not have any patience with Edward anymore. What is this, Edward? You're not controlling me. I'm giving her lines, Edward. You better stay in shape here.
Edward is not getting married anymore.
It's gonna be my fourth divorce.
What?
So she's gonna be my fourth divorce.
It's going to be your fourth divorce. I've seen it all. Oh, I have. Every time I say that, I see something new. All right. So, what's the conclusion? Clifford's control over the property in all significant respects was the same before and after the creation of the trust. The benefits of the income flowed indirectly to him. And the IRS prevails. Okay, the IRS prevails. So, there's quite a few lines I like in this case, but on page 258, the 1, 2, 3, 4th line down. Fourth paragraph down, I apologize. So far as his dominion and control were concerned, it seems clear the trust did not, I have the word not circled in red, affect any substantial change. So with or without this trust, Edward's life was the same, right? Everyone agree? He really didn't separate himself from the property. And then that language is sprinkled throughout this case. Truly sprinkled throughout this case. And as a result of this case, Congress decides, you know what, this is amorphous, right? IRS prevails in Clifford, but do taxpayers back in 1940 know what it will take, what sort of indicia will be enough to call it a grantor trust and what won't? It's pretty amorphous. Everyone agree? You're not sure. What is sufficient substantial control so that grantor trust status is appropriate? So Congress decides to craft Code Section 671. And Code Section 671 essentially says that if you reach this status, that the trust will be ignored. That you'll have grantor trust status. And the last item, or last sentence under 671 says, these rules are the only rules. In other words, if the rules apply here and grantor status happens, you're a grantor trust. But if for some reason you're a non-grantor trust, the IRS can no longer argue, the last sentence says, about dominion and control. So the court is saying we're going to take away the amorphous nature, and we're going to make this a black and white test. Okay, everyone with me? No more amorphous. Black and white. And if it's ignored, the income and deductions are gonna end up on the Form 1040 of the taxpayer's return. So what we're gonna learn as we go through code sections 673, 674, 675, 676, 677, 678. We're going to find out 6 different indicia of what constitutes a grantor trust. So our job is going to be sleuths. We're going to put on our detective hats and try to figure out what will be the indicia to constitute grantor trust status. And then, towards the end of the chapter, the authors ask us with more specificity, what are the consequences? Where would we be in the Internal Revenue Code without a series of definitions? We would be nowhere. So, we pause for a moment and look at Code Section 672. Offers a series of important definitions. Starting with adverse party, a person having, I have the word a substantial beneficial interest in the trust. We have non-adverse party, anyone else? Surprise, surprise, we have a definition of related or subordinate party. And some other rules. Do not, even if the authors phrase it, do not worry anything to do with foreign status. You're not going to be held accountable. Okay? Now, because time is not our friend, let me just turn some pages quickly with you. Let's look at the forest before we get into the trees for next week. So, Code Section 673 deals with reversionary interest, that the property reverts back to the grantor. 674 talks about power to control, beneficial enjoyment, right? That's a pretty powerful thing, right? When you can control beneficial enjoyment. 675, certain administrative powers can give rise to grantor trust status. 676 is the easiest one, right? Revocable trusts. Bear in mind, grantor trusts can be irrevocable or they can be revocable. Certainly if they're revocable, we're going to be grantor trust. 677, hey, if the trust, the income can be used for the grantor's benefit, that has the aroma that you haven't given up much. And 678 gets the moniker eponymously named a Mallinckrodt trust. Code Section 678, don't ask me to spell it, but you'll see it in your case. Mallinckrodt is named after the Mallinckrodt case, okay? And here's an important takeaway, because it's late, you put in a long day, but here's the kind of cool thing. Trust may or may not be grantor trust status as to their entirety. Let me repeat that. That you can have trusts that are grantor trust as to income, non-grantor trust as to principal. So I don't want you to think this is black and white where a trust is either a grantor trust or a non-grantor trust. Some trusts will have a foot in both worlds, where they will be considered grantor trust as to a portion and non-grantor trust as to another portion.
And also reverse, yes?
And non-verse, and the, yes, or it can be the reverse. So just be forewarned, that is the case. And I do see that if you look at chapter 4, again, chapter 4 is fairly lengthy. So we're gonna probably spend the next 2 classes, and those who came in a bit late, again, we're meeting on Wednesday of next week and Friday, but can you plan, this goes up to about page 335, so if you can read about, that gives us about 70 pages or so. So if you can, read another 40 pages or so. You know, if you read to page 300, can't hurt. And then on Friday of next week, we'll try to finish this chapter with the expectation that our last 2 classes will be charitable trust and IRD. Is that like a game plan? All right, so I will see everyone here Wednesday next week. I hope to see you all. If you get a chance, sign up for November 9th.